Hey, Sean Devlin, the mortgage shoes man, 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 shoes man. Hey, Sean Devlin, the mortgage shoes man. Hey, Sean Devlin, the mortgage shoes man, coming at you with Two for Tuesday. We got some guideline updates from Fannie Mae. So we're going to go over those real quick today. First one, Two for Tuesday. Here we go. Has to do with lender-sourced contributions. Fannie Mae has defined a few things that I think maybe had loopholes or wasn't 100% clear and provided more clarity in regards to this. So if it's a lender-sourced contribution, okay, it may not be used, written in the books, dun, 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 for the down payment. I think that's the way it was in the past, but clearly defines lender-sourced contributions may not be used for down payment. They may not be used or subject to repayment. So if it's a contribution from the lender, it cannot be sourced in part of the loan or have any type of repayment subject to it. Pretty self-explanatory. If it is a lender-sourced contribution, it may not be passed on to a third party. Good to know. I think there's some people that were playing that little loophole, and I think they clarified that 100% now. So a lender-sourced contribution may not be passed on to a third party. Pretty self-explanatory. It should also not exceed the prepaids and total of all closing costs. It's what it defined now in the book. So, excess credit, if it does exist, may be returned to the client in the form of two different things. Number one, a principal curtailment, principal reduction. So, most commonly used from a lender's standpoint. Second one, it can actually be returned in the form of cash to the borrower. Clearly identified in the guidelines. Interesting. So, I wonder how many mortgage companies are going to be doing that versus the principal curtailment. I don't even know if it's going to be an option, but something to know that is an option for your client. Technically, it's in the guidelines and is in effect immediately. All right. Construction to permanent financing. Two for Tuesday. Second newest change. Fannie Mae has apparently defined and made it a little bit easier for those doing construction to permanent financing where the lot was owned prior to the construction loan is always viewed as a refi. Whereas they defined it now to make it a little bit more friendly about that whole construction phase. Because if the lot was owned prior to the first initial draw on the construction loan, it is still considered a refi, not a purchase. So you can actually be buying that lot in the process of the loan, if you will. So if you own the lot prior to the first initial, how do they word it? First advance of interim construction financing. So, the first initial draw of a construction loan. If the lot was owned before the first initial draw, it's a refi. After, it's considered a purchase. Great definitions and defining by Fannie Mae to help make the process easier. My name is Sean Devlin, going over Two for Tuesday, talking about some changes Fannie Mae did. I'm going to be in the office all day talking about some strike zones with I got a guy questions. And if you got a guy, hit me up. Strike zone today for tomorrow is USDA loans, 580. here. That's the minimum for USDA. I'm going to talk about that tomorrow. Have yourself a wonderful day. Share, interact, like, repeat. As always, sell well.